I just finished chapter 9, and it's absolutely insane when you understand what actually happened with all of the really cheap debt and the quantitative easing that the Fed was kind of putting out after 2008, with the unemployment being super high during 2010 to 2015. What a lot of these companies were actually doing was taking the money, leveraging the debt from companies, and then selling it back to investors. So there was different types of groups for these loans, and they were categorized to these investors and sold in a separate way, where AAA loans were the least risky is what they were saying. And then there was a tier under that, and then a tier under that. So the second tier would get higher interest rates. That means that they would get a higher return, but obviously the chances of something failing or something going wrong were a bit higher. And then the same thing for the tier below that, where they would have a higher interest rate from the tier above them, but the riskiness of if the loan defaulted or the companies collapsed and the loans went bad, then they would all actually lose their money. The banks and institutions, these people are supposed to be loaning out the money for companies and businesses to be able to make more money in their business, to be able to create more jobs in their industry and take on riskier things. But what they were actually doing was giving out bad debt to companies that were very risky, and then taking those bad debt scenarios, packaging them up together with multiple companies that were bad debt, and then selling it to an investor. And then that investor would now take on that debt thinking that they can get a return on it. And if they can't get a return on it, then they would mitigate the risk that they were facing by selling it. But then when everybody else is in a greed mode, buying and selling, then what happens is that when this things start to collapse, no one wants to buy anymore, and then that completely destroys the market and no one's buying them. And then the money that was being made was by the companies that were making the deals, the lawyers that were setting things up, the underwriters that were writing the things that for to protect the investors and to protect the companies. And now what happens is all the money that the Fed was loaning out was no longer going to the companies to create more jobs and grow the economy, but the investors and the different people who are divvying up the different loans that were being given out so they can try to make money on the back end of what the company was trying to take the risk for and the loans for.